Welcome to this tutorial on financial modeling using Kaluta projection methodology. Last time we did profitability ratio analysis, and to correct tongue wagging, when I was defining operating profit margin, I said it is sales minus direct sales minus operating cost, instead of saying sales minus direct expenses minus operating cost. Okay, so take note of that. And also after getting our projected ratios, we were supposed to compare them with the industry data if we have those data. So that, take note of that also, that your computed ratios need to be compared with the industry data in order to gauge the plausibility of the computed ratios. So after that, then let us proceed with the liquidity ratio. Liquidity is the term that is used in financial and corporate parlance. In financial parlance, it means the ability to convert assets and securities into cash within short notice without affecting the market value of the asset or security. Okay? And for corporate parlance, it means the ability for your current assets to meet its current liabilities. Okay, so the current year normally is the period, 1 year period is taken as the current period. Of course, if the business has longer operating cycle, you can take that, but normally it is 1 year is taken as the current period. So you measure the ability of the company to meet its short-term obligations. Okay, that is liquidity analysis. And here we are going to compute 3 ratios for that. Current ratio, which is current asset divided by current liability. This one measures the extent to which your current liabilities are covered by your current assets. The greater the ratio, the better. Okay, normally a ratio greater than 1 is taken to be a plausible ratio. Of course, you need to look at the industry norms to see if the computed ratio is healthier or not. And quick ratio, we take current asset, we minus stock and prepaid expenses. Stock is the least liquid asset within the current asset component, and prepaid expenses, these are the money that have already been paid. So we deduct them from the current assets in order to establish the current asset that can be converted and get cash. Okay, prepaid, you have already paid cash on that, so you need to deduct it from the current assets. So quick ratio, current asset minus stock minus prepaid expenses, you divide it by current liabilities. And cash ratio, this is the cash at hand. Okay, so cash at hand is the cash you have in the bank, also the interest amount you have within your company, okay, for running the business. It falls under cash. And also cash equivalents, these are the assets that are convertible into cash almost immediately. Okay, and they comprise treasury bills, marketable securities, money market funds, government short-term bonds. Okay, so these fall under cash equivalents. Okay, current liabilities, those liabilities that fall due within a year. So let us start by computing the current ratio. As we did in the profitability, we did our analysis first on monthly basis from year one. Okay, we left year 0 because that is pre-operating period. You haven't yet started making sales, and we started from April, which is operating period, where the operating period starts. So we are going to do the same here. So I'm clicking on this place, edit, and then start with equal sign, current asset minus, divide by current liability. We get these numbers from our monthly balance sheet, projected monthly balance sheet, which is here, balance sheet here. So for April, so current assets, total current assets figure is this one, divide by total current liabilities, total current assets, this figure, divide by total current liabilities, which is this figure here. Press enter. So we get our current ratio for April. And then current ratio, quick ratio, current asset minus stock minus prepaid expenses divided by current liability. So I start with equal sign, and again we get these figures from our balance sheet here, So I take current assets, which is here, total current assets for April, this one. So before that, let me start with, open the bracket, and then click on total current assets, and then minus closing stock, minus advance payment. Okay, these are prepaid expenses, as I said. So minus that one, and then I close the bracket, and then we divide it by the figure for current liabilities, total current liabilities, which is here in April, total current liabilities. Press enter. So we have our ratio there, and cash ratio, cash and cash equivalents. In our case here, it is, of course, again in our monthly balance sheet. So start with equal sign, go to our balance sheet here, cash and cash equivalents in April is here in this cash figure. Okay, and then you divide it by liabilities, total current liabilities, this figure. Okay, press enter. So we have our ratios there. Then I simply select these. Okay, and then use fill, and then drag this to the end of our monthly projected period, that is in third year here. Okay, so we have our monthly computed ratios, and let us go to do the same for annual ratios. Okay, so these are the annual ratios now. Start with equal sign, go to annual balance sheet. Now in this case, annual balance sheet, this one, annual balance sheet. So we take total current assets, which is this figure, divide by total current liabilities, which is this figure, okay. Oh, I took for year 2. Let me repeat that. It is year 1, okay. So let me start again. Edit, equal sign. So annual balance sheet in year 1. So total current assets in year 1 here, okay, divide by total current liabilities in year 1 here. Press enter, and then quick ratio. Start with equal sign, open the bracket, and then go to my annual balance sheet figure here. Pick total current assets in year 1, this one, minus closing stock, minus prepaid expenses, these are advance payments. Close the bracket and then divide this by total current liabilities. Sorry, I've done something here. I think I need to repeat this one. Let me repeat this one. So quick ratio, start with equal sign, and then open the bracket, and then go to current assets, annual balance sheet. Let me look for annual balance sheet, which is here. Then total current asset, which is this figure, minus closing stock, minus advance payment. Close the bracket and then divide by total current liabilities, this one. Press enter, and cash ratio, start with equal sign, go to my annual balance sheet here, pick the cash figure, this one, divide by total current liabilities, this figure here. Press enter. So again I select this and then fill to the rest of other years. Okay, I could do that, of course, but dragging, because the data for year 1, 2, and 3 are following each other consecutively in the balance sheet here. In the balance sheet, annual balance sheet, data for year 1, 2, and 3 are following one another consecutively. So that's why I could drag the formula just to make our life easier, and that is why actually we need Excel, because it makes our life easier. So going back to my computation of the ratio, analysis, which sheet was that one? Annual working sheet. This is sheet for assets, balance sheet, loan, cost of P&L, MSB, ratio analysis, RA here. Okay, so back from here, we now have our ratios and the interpretations of the ratios. The interpretation is, as I said earlier, okay, for all these, we look at the capacity of the company to meet its short-term obligations, okay, those cash obligations expected within 1 year. But we look them in various angles, from taking the total current assets, that means the expected cash within 1 year, from all current assets, okay. And quick ratio is we only take expected cash that is quick enough to be converted into cash. That's why we remove stock and we remove prepaid expenses, of course, because this one has already been paid. Okay, so we remove that to get the quick ratio. And cash ratio, that means we only take into consideration cash balances, and of course cash equivalents, because they are readily convertible into cash from money market. Okay, so the ratio greater than 1 is better, but it also depends on industry norms. Okay, so the rule of thumb is when the ratio is greater than 1, it is better. But the other thing to look at is what is the industry standard for that ratio. Okay, so you need to compare your computed numbers with industry data in order to gauge the plausibility of the efficacy of the ratios that have been computed. So these ones are for the monthly basis. Okay, and as I said, for example, when you are doing budgeting, you do projection on monthly basis. Okay, so you need to see ratios on monthly basis, not annual basis, because the budget period is only 1 year, but broken down on monthly basis. So monthly ratio analysis is the only one that you can use for budget analysis. And the other case is when you are looking for overdraft facility, your presentation will be, your financial forecast will be on monthly basis, and for that matter the ratio analysis needs to be on monthly basis too. Okay, as I said, it's not the tradition normally for the banks to request for all projected financials, that is balance sheet, income statement, and cash flow. They normally request only cash flow statement when it comes to modeling, financial forecast for overdraft facility. But that is, as I said, that is not right way, because you cannot project cash flow in isolation from other financial statement, that is balance sheet and income statement. These are interrelated, and it will be easier to cook data if you are only supposed to present your financials on cash flow alone. Okay, it will be easier to cook data. So you need to the financial the bankers and the people who are doing forecasting need to project for all financial statements instead of only cash flow under the scenario of looking for overdraft facility. So our projected numbers on monthly basis, as I said, they will be interpreted basing on the real situation. Okay, if the business is cyclical, you will find that the ratios differ from one period to the other depending on the cyclicality of the business. So interpreting them, for example, the ratios for April may be different interpreted from the ratio in December. Okay, December normally for the retail business, that is the time when you can do more sales. So even the cash, expected cash, becomes much more during that time. So when you do analysis on monthly basis, you need to look at the cyclicality, and for this matter, comparing April for this year and April in the previous year, it makes more sense than comparing April with the June or the other month. Okay, that is for monthly analysis. For annual analysis, of course, it has already averaged out those cyclicality, so you have the data for annual, and for that matter its interpretation is now easier because the data have already been averaged out. Okay, so you can compare one year and the other year for that matter. Okay, so that's all about the liquidity, and we will proceed with efficiency ratios in the coming tutorial. Thanks for being with me. Check out my other tutorials in order to get a big picture or a full picture of how this methodology is done in order to project for financials. And if you find this useful, please share it with others so that they can also get the knowledge. And if you have any question, just feel free to ask me questions related to my presentation. So bye for now. See you then.